This is Corey with Sims Investment Management. This is another monthly market update. And September 2022 was a frustrating month for a lot of clients. We started getting a few more calls and emails, but maybe not as many as a lot of people suspect. We often get this question of, oh my gosh, your phone must be ringing off the hook. And a lot of times I think that's actually maybe clients or friends or family and people just projecting maybe their own question or their own fear. Ryan Atkins, one of our other advisors, recently said, I think clients just want to know that everything's going to be okay. So hopefully this video will do that for a lot of you this month. Yes, the market continues to decline in 2022. Right now we're about a 23-24% down since January. The market really started to peak last November when you think of technology and small cap stocks. The market is very forward looking, and when I say the market, again, I'm referring to the 500 best, most well capitalized companies in the world. So the market is very forward looking. So right now what we're seeing is unemployment continues to be stubbornly low, which is a good thing, right? And people are fearing that the Fed is going to have to raise interest rates to a level that is going to shock us into a recession. And that that fear of the unknown of where they're going to have to raise interest rates is really what's driving the market right now. As interest rates go up, inherently the stock market tends to go down in the beginning before we bottom and start moving our way back forward again. It's really interesting that over the past, I think, 5 rate hike cycles, that within 6 months of the Fed issuing their last rate hike, they already started to cut rates again because they raised interest rates too high too fast. And we're hoping that the Fed does not do that again this time, and we can thread this needle of bringing down inflation while not allowing unemployment to get too high and dip us into a recession. So the important part there is, again, we are not in a recession right now. There are 11 million jobs open. There are 2 jobs roughly for every 1 person looking for work in America. In the latest survey, it said 16% of people that recently left their job, it was because they are voluntarily leaving to go find other work. That is not a recessionary environment. Typically, when you're in a recession, people will not leave jobs because they're afraid that they won't be able to go get another one. So just please keep that in mind. Really what is driving the market right now is a fear of where we could be in the next 12 to 18 months. While that's also important to realize is the market being forward-looking tends to bottom much sooner than things start to look rosy or good, right? So if we use 2009 as an example, the market bottomed on March 9th, 2009, and the recession didn't technically come to an end until the end of June of that year, and it wasn't declared over until December. So about 9 months later was the recession declared over. It was still pretty dark in March 2009, but you had to be forward looking and realize that it wasn't going to be as dire as what people were predicting it to be. I think, the other thing that we need to focus on is the most powerful emotion investing is long-term regret. So we see people that sell out at the wrong times and then they regret that they sold out. And then they wait to get back in, and then they miss the market going up, and then they regret that, and then they wait for a pullback, and then that never comes, and they regret that. It's just regret. And what we're here to help you do is to avoid that regret by not trying to time the market and instead focus on your long-term investment plan. We don't know if the market's going to keep falling right now, but you could argue that your downside risk is a heck of a lot less now than it was in January. If you're sitting on cash and it's a 9% inflationary environment and we have a 25% off sale on the 500 largest best companies in the world, I would strongly advocate you to consider putting that money to work, because maybe the market goes down another 10 to 20%, maybe it goes down further. But what we're caring about is what is it going to do for the next 100%, and up until this moment, every decline has been temporary and we are in a permanent uptrend. We have a really great newsletter this month with some great articles, some great quotes, some great cartoons from Ryan Atkins. I really appreciated your weekly cartoon submission. And I will leave you with this last thought. There keeps being this talk about the 60-40 portfolio, 60% stocks and 40% bonds. The reason why that's performing so poorly this year is because of the rising interest rate environment and the 40% that people had in fixed income and bonds. Thankfully here, even though we might experience a little more volatility because we focus more on equities, we are not having the down year that a lot of people are experiencing in the bond market. And I'm going to talk more about that next month. So I hope this video helps. If you have any questions, please feel free to call, email, and reach out and forward this video along to somebody that might need to see or hear it. Thanks, and we'll see you next month.